Welcome to Study Loop.
First, we will review the concept of deadweight loss. Deadweight loss is a fall in total surplus that results from a market distortion, such as tax. We can illustrate deadweight loss from a tax in a supply and demand diagram. The red dot represents the initial equilibrium where there's no tax. After tax, the quantity reduced to a smaller level. The size of the tax is represented by a vertical distance in blue, and the rectangular in blue represent the tax revenue, which is collected by the government. You can see that after tax, the buyers pay a higher price than the initial price equilibrium, and the sellers receive a price that is lower than the price in the initial equilibrium. Deadweight loss is this area, the triangle. This triangle of which area is decided by the size of the tax and the reduction in quantity. The size of the triangle will depend on the elasticity of the supply curve and the demand curve. Now let's come to the first statement. A tax that has no deadweight loss can raise revenue for the government. This is an incorrect statement. It is incorrect because we can find an example where a tax with no deadweight loss but still raised revenue for the government. It happened when the government imposed the tax and demand or supply is perfectly inelastic. So this is the situation of a inelastic supply. And this is the illustration of perfectly inelastic demand. When we have perfectly inelastic demand or supply, a tax will have no effect on the quantity, and it causes no deadweight loss. But still raise revenue for the government. That is part A, and in part B, a tax that raises no revenue for the government can't have any deadweight loss. This is also incorrect. A counterexample is the case of a 100% tax imposed on sellers. The sellers, in this case, will not supply any of the goods, so the tax will raise no revenue. Yet the tax has a large deadweight loss. because it reduces the quantity sold to zero. So we can illustrate that on a diagram of supply and demand as follows. This is the initial equilibrium. With a 100% tax on the sellers or on the sales of goods, then the deadweight loss would be the whole area here. And the quantity, given this very heavy tax, is zero.